As a business owner, how do you ensure your corporate wealth transfers efficiently to your heirs? To answer that, here's Promod Sharma, the actuary at Taxevity, your insurance architect for protection, growth, and impact.
In this video, we'll cover the two distinct layers of tax that apply to corporate investment income and why this creates a significant challenge for your estate plan. Successful business owners often accumulate significant retained earnings inside their corporation. The natural next step is to invest that capital. However, a problem arises because corporate investment income is taxed very differently and much more heavily than active business income. This heavy taxation creates a barrier to transferring that wealth from your company to your heirs. The first layer of tax occurs inside the corporation itself. When your company earns passive income, that income is subject to tax at a very high rate. This applies to income like interest, dividends, and rent, where the corporate tax can exceed 50%. This high rate is intentional. It is designed to discourage using a corporation as a personal savings vehicle. While capital gains receive more favorable tax treatment, they are still subject to this two-layer process. The result is that a significant portion of your investment returns are immediately lost to corporate tax before that wealth can be moved to your estate. To move that after-tax profit from the company to your estate, it must be paid out to the shareholder as a taxable dividend. This dividend payment triggers the second layer of tax. The estate, as the shareholder, must then pay personal income tax on that dividend. When comparing the use of corporate capital, the critical measure is not the initial investment return, but the net amount that is ultimately received by your heirs after both layers of tax are paid. This double taxation presents a fundamental, structural challenge for any business owner looking to transfer corporate wealth to the next generation. It effectively means that for every dollar your corporate investments earn, a large portion is earmarked for tax, not for your family. Understanding this inefficiency is the first step toward implementing strategies designed to solve it. The fundamental point for an incorporated business owner is that understanding these two layers of tax is the first step toward creating a more efficient estate plan.
The real question is how much of your life's work will actually reach your family after these two layers of tax take their share. Before you commit capital, get clarity on the feasibility with Taxevity, your insurance architect.